A major change could be coming to Britain's tax system, one that may affect the housing market, trigger political arguments, and place new financial pressure on hundreds of thousands of households. Reports suggest that about 300,000 homes could face an extra £2,000 a year in council tax under proposal being considered for the 26th of November autumn budget. This new charge, often described as a mansion tax, would apply to higher value properties, particularly in London and the South East. But the issue is bigger than simply taxing expensive homes. It raises important questions about fairness, regional differences, outdated council tax bans, and the wider economic impact of increasing property-related taxes at a time when living costs remain high. In this video, we break down exactly what's being proposed, who it affects, why it's happening now, and what it could mean for the future of the UK housing market. Reports indicate that the Chancellor Rachel Reeves is assessing a plan to impose a new levy on the most expensive homes in the country. This follows her decision to avoid raising income tax, a move that would have broken a key Labour manifesto promise. Instead of raising income tax, this new approach focuses on revaluing properties in council tax bands F, G and H, and then applying a separate surcharge to the top 300,000 most valuable homes. As part of the plan, homes in the top 3 council tax bands in England will be revalued, with the most expensive 300,000 properties then charged the new tax. Based on recent property transaction data, estate agent Savills said it expected the levy would hit homes in council tax bands F, G and H valued at around 1.4 million and above. Hamptons estimated that the threshold would fall at roughly £1.5 million. For many people across the UK, a price tag of 1.5 million immediately sounds extravagant. That kind of figure associated with large mansions, sprawling driveways and luxury lifestyles. And on paper, it is a huge amount of money. For people who do not own a home at all, or families living in cities where buying even a modest property feels impossible, that number can seem completely disconnected from ordinary life. But here is the reality that often gets lost in these discussions. £1.5 million is not a mansion in much of London and the South East. In fact, it is shockingly common, and in many cases it represents homes that would be considered modest or even small in other parts of the country. More than 80% of the properties that would fall under this proposed tax change are concentrated in London and the South East alone. That means the impact is not evenly spread across the nation, it is overwhelmingly regional. And for anyone living outside those areas, it can be staggering to learn that £1.5 million actually buys in London. It is not a palace, it is not a stately home. In many cases, it is a terraced house on a narrow street or a semi-detached property with no driveway and a tiny bit of garden space. These are homes that look ordinary from the outside, not the kind of places most people would call mansions. Take a look at this screen recording of houses being sold for £1.5 million in London. You would hardly describe them as mansions. What you're seeing is the reality of a housing market that is drastically more expensive than the rest of the UK. London's prices are not comparable to national averages, and that's the core issue. A figure like £1.5 million sounds extraordinary if you live in the Midlands, Scotland, the North or Wales. But in London, it's hardly what you would describe as a mansion. These homes would be charged the new amount in addition to their existing council tax bills, potentially adding, on average, of £2,000 per year. While the number of affected properties is small relative to the entire housing market, the change carries national implications because council tax banding has remained frozen since 1991. That means millions of homes are effectively tax-based on 34-year-old valuations. It's thought that owners of properties over the mansion tax threshold will be hit with an average £2,000 bill, with the government hoping to raise £600 million through the measure. Almost a third of the properties in Reeves sites are flats, according to Hamptons. Almost a third of the properties expected to be hit by Rachel Reeves' planned £600 million mansion tax are flats, new analysis suggests. Around 100,000 apartments are likely to face a new surcharge, which would affect properties in the highest 3 council tax bands in England, according to estate agency Hamptons. The types of flats affected are both apartments in new build towers with amenities such as concierges, gyms or swimming pools, as well as 3 or 4 bedroom properties in converted townhouses or older buildings. Tom Bill, head of UK residential research at Knight Frank, said, "The Treasury will be delighted that the term mansion tax has caught on among Labour backbenchers, but it's unlikely to reflect the reality on the ground for many homes." Some homeowners could also be allowed to defer the additional charge until they sell their home or until death, an attempt to avoid placing immediate financial strain on retirees or households who are asset rich and cash poor. In simple terms, this measure acknowledges a long-standing problem in the UK housing system. Many people, especially older homeowners, bought their homes decades ago when prices were far lower. Today, those same properties have skyrocketed in value, but the owners' incomes have not. Many now live in homes worth far more on paper than their modest or below average incomes can realistically support. On the surface, offering a deferral sounds like a compassionate solution, but once you look closer, it becomes clear that this creates a whole new set of problems. One of the biggest challenges is that tax systems built around property valuations are fraught with complications because they rely on assessments that fluctuate, can be disputed, and often lag behind real-time market conditions. The advantage of using council tax as the mechanism for this new charge is that it can be implemented immediately. It is an existing system that everyone already pays into. There is no need to create a new administrative structure, no need to track historical prices, and no need to calculate individual gains over time. It is simple, predictable, and fast for the Treasury. But the moment the government considers alternative tax structures such as capital gains or proportional annual property taxes, the situation becomes far more complicated. Take capital gains tax as an example. If the government tried to tax the gain on the portion of a property above 1.5 million, it would mean calculating how much the home has increased in value between the time it was bought and the time it is sold. For many people, that purchase may have been decades ago. That creates instant problems. It is difficult to calculate fairly and even harder to administer. But the biggest issue is behavioural. If homeowners know they will face a large capital gains tax bill when they sell, especially in London and the South East, the simplest response is not to sell at all. And once people stop moving, the entire housing market begins to seize up. Larger family homes stay occupied, younger families cannot move up the ladder, supply gets tighter, prices stay inflated, and crucially, the government does not receive the tax revenue it was depending on. This becomes even more complicated because capital gains tax is wiped out at death. When someone dies, the entire gain on their home disappears. The property is reset to its current market value for tax purposes. That means the government only receives inheritance tax, not both taxes. But if that same homeowner had sold the property during their lifetime, the Treasury would have collected capital gains tax first and then inheritance tax later. So if the government is counting on capital gains revenue, but homeowners choose not to sell, a huge funding gap appears. The money they expected simply never materialises. Proportional property taxes, such as charging 0.5% or 1% of a home's value each year, come with similar problems. Unlike council tax, which is already in place, a brand new annual charge cannot be introduced overnight. Imagine buying a home today, paying a large amount of stamp duty, and then waking up tomorrow to discover an additional annual tax based on your property's value. It would spark outrage. It would freeze the housing market, and to many, it would feel profoundly unfair. This is why Reeves is focusing on council tax. It is the easiest mechanism to adjust. But even here, ideas like allowing people to defer the payment until they sell, or even until they die, run into the same trap. If people know they can delay paying, many will simply wait indefinitely. The result is another revenue gap, money owed on paper, but hardly any of it collected in reality. Housing mobility slows even more. Older homeowners stay in properties they might otherwise downsize from, younger families cannot find larger homes, and the Treasury ends up with billions in theoretical tax debt that might not be paid for decades. The pattern is clear. Any system that depends on homeowners selling their properties to generate revenue will naturally encourage them not to sell. It becomes a self-defeating cycle. And as long as the government looks to property taxes to fill major fiscal holes, those unintended consequences will continue, potentially locking up the housing market at a time when it desperately needs movement, not paralysis. This speculation has already affected the property market. Budget speculation has depressed the UK property market. Figures from a leading property website have suggested with asking prices slipping in the run-up to Rachel Reeves' much-anticipated fiscal set piece on the 26th of November. The average new seller asking price fell by 1.8% or £6,589 month on month in November. The figures collated by the property website Rightmove set out, taking the average price tag on a British home put up for sale to £364,833. The data has emerged as the Chancellor has come under pressure to reform property taxes, with housing market experts, including the TV presenter Kirsty Allsop, saying people are in panic about potential stamp duty changes and sitting tight before the budget. It is fairly common for prices to fall month on month in November, when the average monthly price drop has been 1.1% over the past decade, Rightmove says. However, the current fall is the biggest for this time of year since 2012, with 34% of homes on the market reducing their asking prices and then implementing an average price cut of 7%. Both numbers are the highest since February 2024, the website says. The gloom in the market is thought to have been partly fueled by speculation about the contents of the budget, particularly for more expensive properties. This speculation has already affected the property market, and the latest data shows just how sensitive the housing sector is to uncertainty. According to new figures from Rightmove, the average asking price for a UK home dropped by 1.8% in November, the largest fall for this time of year since 2012. Nearly 34% of sellers have already cut their asking price, with the average reduction now at 7%. Estate agents and analysts say the mood is noticeably tense, particularly among owners of higher value homes. Even TV presenter and housing commentator Kirsty Allsop has warned that people are in panic, choosing to sit tight rather than list their homes until the budget is released. This sudden slowdown is being directly linked to fears over what the so-called mansion tax might mean for those who could be affected. And this is just the impact of speculation. The policy has not even been announced yet. If the measure is introduced, the distortions could go much further. If older homeowners are allowed to defer the payment until they sell or die, many simply will not sell. And if younger households know they will face higher annual housing costs, they will hold back from moving too. When both groups freeze at the same time, the entire housing ladder jams. Fewer homes come onto the market each year, supply tightens, prices remain high or even rise further because demand still outweighs availability. And first-time buyers, already struggling with record deposits and high mortgage rates, are pushed even further out of reach of owning a home. In the end, a policy designed to raise revenue could end up reshaping behaviour in ways that reduce mobility, deepen inequality, and make Britain's already strained housing system even harder to navigate. If you found this breakdown helpful, don't forget to like, comment, and subscribe.